At over $270 billion of assets under management, we're one of the largest owner-operators of real estate in the world. The access to capital we have is unparalleled. Our strategies are among the largest of their kind in our private funds. We have some of the largest clients in the world who want to co-invest alongside of us, and we have access to the corporation balance sheet. We can simply do things that others can't.
We think this market is particularly suited to our strengths, and so I'll highlight those. Number one, certainly scale. So scale has always made us a preferred buyer, but as I said, in this market particularly, it's made us, in many cases, an only buyer, which is fantastic. Second is our relationship. So as you know, we're local in every market that we're investing in, and that allows us to create these direct relationships. In a market like today, that's turned into essentially off-market bilateral sourcing of transactions. Third, of course, is our operating expertise. This is our hallmark. I would say, if you look back over the last couple of decades, there are certainly investors who could have done well investing in real estate by the benefit of interest rates coming down over 2 decades and values moving up, even if cash flows weren't moving up. I think we're in a very different environment today and going forward.
So where are we today in the real estate cycle? And I'd say it's a pretty unique moment. We certainly see a lot of capital stress given the high interest rate environment over the last couple of years. Many owners which are over-leveraged and undercapitalized. However, the macro picture has been surprisingly resilient, and GDP is not contracted. Therefore, demand has remained pretty healthy for real estate. And importantly, we're seeing very low levels of supply. Certainly over the last 2 years, there's been very little new construction, but really going back to the pandemic over the last 4 or 5 years. So it's very much in balance, producing strong fundamentals, yet stressed owners. And that's a pretty unique point in the cycle, which is quite different. The last 2 years, we all know have been volatile, they've been uncertain. We've had many headwinds in the real estate sector with high inflation, high rates, uncertainty, persistent fears around recession, and that's really essentially froze the transaction market for a good part of the last 2 years. But in our view, that's in the rearview mirror, and we believe we're already operating in the next phase of the cycle in real estate.
And so where we are today, every one of those issues we feel like has been materially mitigated. Inflation coming down and under control in most markets around the world. We've reached peak rates now coming down across the US and across Europe. Therefore, debt markets reopening and pretty widely open at this moment. Economies have proven to be resilient around the world. Cap rates have stabilized. We think values have bottomed and transactions are now returning. So we're particularly excited about this new phase of the cycle. And we think it's going to be a great time for our asset ownership and for new investments.
The wall of maturities that's occurring over a 3-year period, nearly $3 trillion of maturing debt in the US and Europe alone. That's creating opportunities, whether it's distressed loans and non-performing loans from creditors, whether it's forced sellers because they can't refinance their debt at par, or opportunities for us to provide structured capital to mitigate the gap in financing.
So talk a little bit about sourcing. We're tracking pockets of stress, and that stress is coming from multiple places. We're seeing it in closed-end funds that are getting to the end of fund life. We see it in open-end funds through redemption queues that are building. We see it a lot in financial stress just from debt coming due or high debt service costs. So what we're doing in relation to that is literally just approaching those owners. Right? You can very clearly identify who they are and who needs liquidity. And so we're proactively approaching those owners. And again, that's turning into really off-market transactions. That's turned into opportunities to buy really high-quality assets at steep discounts.
Private funds. In the US alone, we've seen over 50 billion of open-end fund redemptions, forcing owners to sell assets, oftentimes their highest quality and most liquid assets, and they're looking to us as a trusted partner where we've acquired a number of assets, and closed-end funds which are reaching the end of their fund life, and public real estate companies which have rebounded broadly over the last several quarters, but there's still many examples of public companies that have challenged or broken capital structures with an inability to access public debt and equity markets, and that's producing M&A opportunities.
And what we're seeing around the world is different market by market. Broadly speaking, I would characterize Europe as a place that we're focused on deeper value, capital market stress, creating these deep value opportunities. contrasted very much by what we're seeing broadly across Asia Pacific, where it's less about stress in the capital markets, much more about growth and really strongly growing economies. I put the US somewhere in the middle between the two. So really a place that we're seeing the capital stress is clearly there in the capital markets, but also at the same time, decent growth prospects across the US economy and for our real estate there.
Over the last 12 months, we've been active. We've steadily seen our activity pick up. We've acquired $6 billion of assets in over 100 transactions. Two examples here of a multifamily portfolio in the US and a logistics portfolio in the US, both of which were north of $1 billion in asset value. We believe we acquired these at roughly a 30% discount to their peak valuation. And importantly, we're using our operating platforms to drive additional value through active asset management.
We've been saying this for a little bit of time, but now it's become even more obvious. But we think this is the best investing environment we've seen since at least 2010, and very possibly might be better than it was even then. So we're seeing it already in the execution of what we're doing, and it's pretty fantastic.
So if I can leave you with one thought about the real estate sector, it's an incredibly unique time to be investing in it, given where we are. We're very excited about it. We've got the experience, we've got the expertise, the track record, and the capital to continue to gain market share in this sector and continue our success.